I have a couple questions.
Sure.
I was just telling you earlier that you're like one of my favorite Bitcoiners, because you have 35 years?
Yeah.
Right, 35 years experience in a risk chair. What does that mean to be in a risk chair? For those that may not know what that means.
Well, on a trading floor, all the real estate you own is a chair.
Yeah.
And there's an expression that it's not the person that makes money, it's the chair. Because if that chair is situated with enough flow, where the salespeople have clients that are trying to buy and sell, and it flows through your chair as a trader, the chair can make money. But that's on a big trading floor. The reality is most money is managed with one or two chairs in a firm. And so when I say I've sat in a risk chair, that includes trading floors that are 300 people large and a firm as small as 2 people.
Mm-hmm.
But the chair itself is a responsibility, a fiduciary responsibility to manage your client's money or your institution's money in the best efforts to optimize returns for the lowest level of risk.
Yeah.
So that is the risk chair per se. It could be a trader's chair, it could be a portfolio manager chair. Doesn't matter, you're still managing risk return on behalf of your employer or your fiduciary.
Mm-hmm. And it's not just for you, it's for your clients and
That's correct.
for the company.
Well, yeah.
Yeah. So how on earth, because you're an experience with bonds and fixed income
Yes.
debt instruments.
Yeah.
So when, like me personally, when I speak to most people, they view Bitcoin as a very high risk investment tool or not even investment, worthy investment, but speculation.
Yeah.
So how did you make that jump to Bitcoin? And why are you so passionate about it as a bond
Great
risk
question.
share?
Great question. Well, first of all, let's be careful that most of Wall Street and any Bank Street or Bay Street in Canada measures risk using volatility, and you can argue that that's the wrong metric to measure risk with. For example, if the price of an asset goes from the top left to the bottom right in a straight line down, there's no volatility.
Yeah.
But what's the risk? You've lost all that money, but measured as volatility in a straight line down, there is no volatility. Well, tell me there's no risk, but you've lost 50% of your capital. That's not necessarily the way you should measure risk, but Wall Street has adapted volatility as a measure of risk, which it is, but it's not the all-encompassing. So hence, when you hear that Bitcoin is risky, a lot of times it's because people say, look how volatile it is. But there's a great investor in the United States, his name is Bill Miller. And Bill Miller was the manager of the most successful mutual fund over a period that beat his benchmark, which was the S&P 500, consistently for some crazy number of years, like 20 out of 20 years, which meant he provided alpha or a risk, incremental return for the same level of risk that was superior to any other portfolio manager. Bill Miller has a different view. He says that volatility is the price of return, meaning I drew an asset that went this way in a straight line. Most assets hopefully go from the bottom left to the top right because that's increasing price, but they don't go in a straight line. And the best performing assets over time tend to be very volatile, but achieve a substantially higher price target than something that's less volatile, but attains a much lower price target. So Bill Miller, again, said the risk that volatility is the price of return, meaning you have to be in volatile assets to earn the optimal or highest return. And it makes sense.
Yeah, and I think that's also true with technology. That if we take the internet as an example, like the internet didn't become what it is today in a linear path. Because it's not just an asset; it's also like technological adoption has to happen at a volatile pace.
Yeah.
So when it comes to Bitcoin with bonds, what kinds of risk Because most people look at bonds and they say, look, I'm getting a good yield.
Yeah.
It's secure. It's the U.S. government or it's Canadian government or any sovereign nation. Like, considering the current state of the world, how would you articulate the risk in bonds given your experience?
Well, let's be careful. So for any fixed income asset, otherwise known as a bond, it's called a fixed income asset because the coupon or your return is fixed. In the event that things start going really well for a company that has a fixed coupon, it's not like they'll say, hey, things are so good, I'm going to increase the return on the bond because we're doing really well. No, that return accrues to the equity holder. Okay, the second priority claim. But the flip side is when things go really badly and the company can't make the contractual return, that's when the price of the bond goes way down because people anticipate bankruptcy. There are 3 risks in every fixed income instrument. Okay, there's liquidity risk, which is the risk that you realize you've made a bad investment and you want to sell, and there's no other buyer out there to buy it from you because they realize, why would I buy this at a price of X cents on the dollar? Because we all think it's going down here. So even though you know you've made a mistake, you can't get out. So that's called liquidity risk. There is default risk or credit risk. Both there's somewhat subtle differences, but they're both intertwined. Credit risk is the potential that default risk changes over the life of the contract. Doesn't mean that default is inevitable, but what it does mean is the coupon that you initially charged should have been a higher coupon to account for the risk, and the bond price goes down and hence is volatile, but maybe it still makes its final principal payment. So the price of the bond went from here all the way down to here, but came back to 100 cents on the dollar. But when you owned it down here, you had made a bad investment on it because the coupon wasn't big enough, okay? So that's the second risk. Again, to reiterate, there's liquidity risk, credit risk, and then inflation risk. And those 3 components of a yield are what makes fixed income investing difficult, because you have many unknowns, those 3 components that go into, you can never say a treasury bond is illiquid. It's the most liquid market in the world. But corporate bonds maybe become very illiquid, and the price movements are gaps down in significant amounts of price. That's a risk that always has to be compensated for when the contract is initially drawn up, which is your coupon. A contractual return on your money over time. And I don't want to make this more difficult, but the reality is fixed income pricing is very difficult. It tends to be asymmetrical because when things go well, it's not like the price of the bond will ever double. If things go well, all you've earned over the life of the bond is the initial contract. If things go poorly, everyone questions that initial ability of the company to pay that contract. The price falls, maybe it comes back, but sometimes it falls and there's a default. And the $100 you invested might be worth 40 cents on the dollar at the end of the day. So fixed income investing is a pretty, I always say fixed income investors are pessimists and equity investors are optimists. The reason fixed income investors are pessimists, I've just laid out, there is no real upside, only majority downside. Equity guys, though, are a funny breed. Oh, I plug this into my model and growth is going to continue at 25% annually just forever because trees grow to the moon. Equity guys, right? I mean, trees will grow to the moon. Okay, you can believe that, but they don't. It's mathematically impossible. Yet, on a day-to-day basis, the way equities are priced are primarily on growth because there's no contract in there. Nothing in equities is a contract. It's all subjective growth opinions of cash flows.
It's an assumption.
It has to be because it's not a contract. Bonds are a contract. Equities are non-contractual.
And so it basically sounds like that what most people do is they diversify in the 60-40 portfolio between the contracts and the assumptions, stocks and bonds.
Makes sense.
Because with stocks you have the
asymmetric upside.
Asymmetric upside. With the bonds, you have the asymmetric downside.
But protected by a contract.
Yeah, but protected. So between the two, or maybe perhaps interjecting something like Bitcoin or gold or some other commodity, what does that look like now? Because when I look at that and I see the contract, I'm from the United States, so I look at that and I see we have 130 trillion in liabilities, which is millions of dollars, or almost $1.5 million per taxpayer.
Okay, that's about right.
Yeah, roughly. So it's like I think about that, and I think about these contracts and these liabilities we have in the U.S. with Social Security, all the liabilities, and then realizing that the rest of the world, that all these fiat instruments and all these people in these different areas have all these liabilities and all these contracts coming up.
Yeah.
And so with these bonds, with these contracts, what happens when 1 + 1 no longer equals 2?
That's the problem. It's basic mathematics. That we are stuck in a world where people assume that the risk-free asset, the U.S. Treasury bond, because that's what you're taught in school, is in fact a risk-free asset when it's not. It may be contractual, it may give you a level of comfort, but the question becomes, are you earning the appropriate return on that risk over the life of the bond? And the kicker is that it's paid in fiat currency. So even though, let's say it's a 10-year bond, even though you might invest at a coupon at time zero that gets paid out over a period of 10 years at 100 cents on the dollar plus all the coupons, what is the value of the debasing currency over that time? And this is why Bitcoin is so exciting for me, because I'm not predicting the outright default of many fiat currencies. Well, in fact, I'm predicting the outright default of many of them, but not the most important ones. Bitcoin hedges against the debasement risk on the largest asset class in the world. And the largest asset class in the world is debt or fixed income. So everybody in the world that owns debt needs to own Bitcoin to hedge against the reality of the debasement of the principal.
Yeah.
It's that simple.
Yeah. Well, it seems to me, we were talking at dinner about engineering, and my show with Preston, we talked about the law of conservation of energy.
Yes.
And it seems to me that when I look at that, it seems that either when we have a contract like that that is basically outside, where they can't be fulfilled within reality, that either the political contract has to break, or the unit at which that contract is denominated in has to decline. Yeah. So is that a pretty?
I think so. Yeah, absolutely. Well said.
Okay.
Same thing. You're saying the same thing that I was saying.
Yeah, from an engineering perspective.
Sorry.
Yeah, no, it's all right. So what do you think that means for the average person that's perhaps watching this or thinking about it that has a 60-40 portfolio? I hope you're enjoying this content and appreciating all of the work that goes into it. And there is a lot of work that goes into producing all of this content. And it would not be possible without companies that provide value in helping me be able to fund and continue putting this content out there. So in light of that, I want to thank one of my sponsors for today's episode, and that would be, appropriately, Proof of Work Properties. To tell you a little about Proof of Work Properties, it is a Bitcoin and real estate focused acquisition company. And the Proof of Work Properties team, seeks to discover and develop a relationship between Bitcoin as an asset class and real estate as an asset class. Because in a hyper-Bitcoinized world where there's mass Bitcoin adoption, we really don't know what that's going to look like. We don't know what those implications are going to have on other asset classes, including real estate. And so Proof of Work Properties is attempting to utilize Bitcoin as a collateral tool to back said investment properties to help save them from altcoin and debasing destinies, to give them extra backing and resilience compared to other real estate property development and acquisition companies. So whether it's Bitcoin key pairs or keys to a property, Proof of Work Properties provides keys to your future. So if you're interested in learning more about their strategies and their acquisition process, both for Bitcoin and for real estate, you can contact them. Their information is on the screen here as well as in the description. So please check them out. If you're curious learning about more, if you have rental properties or you're curious in acquiring more rental properties, you want to hear what their strategies are doing, please consider checking them out. They'd love to have a conversation with you and discuss win-win opportunities, value for value opportunities for the short term and for the long term. So again, that's Proof of Work Properties. I want to thank them for helping put in some work to make my work even more available for more people and educating folks about Bitcoin. So without further ado, let's get back to that Bitcoin content.
The 60-40 portfolio worked well when interest rates started at a level of, higher than 5%. And the reason is because, well, when I started trading bonds, interest rates were as high as 18%.
Yeah.
When you bank an 18% return over a period of 20 or 30 years, that compounds. And that compounding of interest largely makes up for some of the debasement of the currency. Not all of it, but even over that period of time, net, you've probably lost money on the currency or on the total trade because of the debasement of the currency, but still you were fighting to keep your head above water.
Yeah.
When interest rates went to under 1% in the 10-year US Treasury rate, and in the case of European bonds to negative yields, like, guys, it's only math. It doesn't work. It's dumb. So the 60-40 portfolio, 60% equities, 40% debt, or another way of saying it, you hold as much debt in your or bonds in your portfolio as your age. So now I'm 60. My 60-40 portfolio should now be 40% equity, 60% debt, according to the the old rules. That couldn't be farther from the truth. Boomers like me, they have 60% of their retirement income or retirement assets in bonds, blown out of the water. Blown out of the water just because of the mathematics of the coupon on the debt, nowhere near enough to compensate for the 3 risks that I mentioned before. Also, the debasement of the currency risk. It's just so sad. And yet most boomers are that's what their portfolios look like.
So why are financial advisors that get paid 0.5%, 1%, or even 2% a year if it's so obvious?
Yeah. They haven't done their work. And let's be honest, most financial advisors took marketing in college. I hate to say it, but the best financial advisors in the world aren't the ones that are good with mathematics. They're the ones that are good at smiling and dialing. They've attracted assets because they're good looking. They go out, they tell a great story, and they get 2 of their friends to tell the same story. They're not that fucking smart. Sorry to you can edit that out, but they're just not. They're just not. It's sad.
So if the majority, as in any industry, if the majority aren't by definition above average, at what point does it become common knowledge, a common realization that Bitcoin is basically this form of insurance?
Yeah, it's great question. I mean, you can't say when it happens. It's sometimes slowly, then suddenly. The bigger picture might be adoption happens. I think Jeff Booth says this. You only need to have 4% of a population to start a movement, right? Well, same within the financial advisory. Imagine if only 4% of the financial advisors finally understand Bitcoin. It starts a revolution. And the other guy on the floor says, well, damn, he's getting more client assets because he has a better portfolio. What's different between his portfolio and my portfolio? Oh, he has this thing called Bitcoin. So, 4% starts a revolution, and the other 96% come on as osmosis or whatever you call it, right?
Yeah. I haven't heard that quote about 4% from Booth, but that's interesting to me because my big number's been 5%. I wonder what the world's going to look like when Bitcoin has a 5% adoption because I feel that a lot of people think Bitcoin won't change the world until it's 100% adoption.
No, it's these same numbers, okay? Yeah. And by the way, maybe I'm misquoting if it was Jeff. I'm not sure if he put it in his book, but he's definitely said something along those lines to me. It's really insignificant amount of people that start this movement, and then it basically becomes grassroots.
Takes off on its own. So I want to throw you a metaphor I've been using based on the idea with the 4 or 5% idea, and I want you to tell me if I'm really out there or incorrect. The way I've been putting Bitcoin is that basically it's a form of fire insurance on a house that's already basically contractually destined to burn down or continue burning down.
I will agree with that, yeah.
Okay, and then when buying Bitcoin, what one is doing is increasing the demand for that or increasing the value of that insurance.
Yes.
Because they're buying that. And because I view these fiat contracts as an open system and this electric monetary system is closed.
Yeah.
What one is basically doing, at least the way I view it from an engineering perspective, is that they're sucking air, sucking energy out of the open system. So like a ship that's sinking, you're causing it to sink faster and putting energy there. So So my question is, if that assumption is true, what happens when the average, say, financial advisor or risk chair begins to allocate 1%?
Well, then it's like, okay, so let's go back to a lot of these things you said.
Yeah.
I love that. I'm going to quote Michael Saylor here. Open systems leak energy, right? So a hydraulic system that has a leak in it doesn't work. Mm-hmm. That's much like any energy. And Bitcoin is a closed system. So the fiat system is leaky, and Bitcoin is a closed system that doesn't leak. By definition, then, that closed system should attract energy from this leaky open system. And I think it's going to do that. All of these things being said, you never know how it evolves over time. If you have done the mathematics and you know that it just gets there, you have to be comfortable in knowing mathematically it's certain that it will get there, but you're not certain of the path. It could go like this, or it could go like that, or it could go, you don't know. But mathematics don't lie. So if you are comfortable with your math and you know that mathematics is the base layer of everything, you just have to own your fire insurance and don't sell it until it gets to your price target. But the reality is, once it gets to your price target will have changed, because all of the things that if you were worried about coming true have come true, and it'll just make Bitcoin that much more valuable.
Mm-hmm. Yeah, I love your flow chart. I meant to show it to you today, but we didn't get the chance. Where I've actually expanded on it.
Okay, good.
And edited it a bit. But you're
so that wasn't my chart. Someone put that out.
Oh, that wasn't.
Yeah, I never
really?
did it. Yeah, isn't that cool? That's what Bitcoin Twitter does, right? Like they take my rambling and squeaky voice and everything, and they put it into a flow chart so they don't have to listen to me, and basically, put it out figuratively and graphically. It's nice.
It's brilliantly simple.
It's that simple.
900 trillion global financial assets, 5%, 45 trillion, 20 million coins, and
2 million plus of Bitcoin,
Yeah.
US dollars in today's dollars. I need to keep saying that,
Yeah.
because 900 trillion is measured in today's dollars.
Yeah.
Well, obviously it's going to be bigger as the dollar debases, the value of those financial assets go up. So you're measuring it in today's dollars. So people will say, at what price would Bitcoin have to trade to surprise me? I don't know, above $2.5 million. Otherwise, I fully expect Bitcoin to trade at over 2 million US dollars per Bitcoin in today's dollars.
I really hope that you're enjoying all the work I'm putting into this content. I do my absolute best to put out as much free Bitcoin-only content as I possibly can. Content about Bitcoin as a monetary singularity, Bitcoin technically, Bitcoin abstractly. Hopefully not just providing more content, but different contextualizations and different ways of thinking about changing mindsets from political currency mindsets or the ancient mindset into what we believe is the modern mindset or the new information digital age mindset. And while I really enjoy doing that, the reality is that, number one, that doesn't pay the bills, and number two, my time is finite. My time is finite, and there are lots of people that have been seeking me out, trying to find a way to be able to talk to me. Maybe some of them have questions, some of them have Bitcoin businesses that they're just starting out, and they want to have either an advisor or a partner or just someone to throw ideas off of. Perhaps they have different asset classes, they're debating what they should do, who should they talk to take the next step, whether that's self-custody or collaborative custody, whatever it may be. Wherever you are on your Bitcoin journey, wherever you are in your investment journey, wherever you are in retraining your brain to think from this new context, my time might be valuable to you. And if it is, I would encourage you to consider signing up for my consulting and coaching group. There are no market advantages in talking to me. I have no market insight. This is not a financial advisory role. This is not a get-rich-quick role. You are doing nothing but buying an hour of my time a month. We can have a phone call or a Zoom call or whatever you want, and we can just talk about whatever you want. Well, the reality is that some of them also have told me point blank that, Luke, I just wanted to grab a slot of time with you because I know in the future time is going to be even more valuable, and they're probably correct. The demand for my time will probably go up exponentially as Bitcoin value goes up exponentially. So If that's something that you'd be willing to consider, I think it could bring value to you. You could sign up for 1 month, you could stay for as many months as you want, but do be warned that price will probably go up over time. So if you want to check that out, that link is in the description for my coaching and consulting. I hope that it brings value to you, and even if not, even if that's not the right avenue for you right now, no problem. There's still lots of free content that I'll be putting out there, including this video. So let's get back to the content.
Now, one thing to understand real world is liquidity. And my question is, there's 21 million Bitcoin, yes, but there's only, two...
A tradable supply?
Yeah, tradable supply. So if we take that 45 trillion divided by 20 million, you get just about 2 million.
Yeah.
What happens, though, Greg, when that amount of US dollars or fiat political currency units flow into that remaining liquidity of tradable Bitcoin?
I guess this is what you get: gamma squeezes, you call it whatever you want. You get a face-ripping rally where you're like, I saw the fire coming. I just wanted to get a little more fancy and try and buy my fire insurance. Instead of being 98% cheap to its intrinsic, I wanted to buy it at 99% cheap to its intrinsic. See, that's horrible risk management. So you can't do it that way. Mm-hmm. But the stupid money will do it that way, and then they'll miss the boat. That's what it is. There's a lot of stupid money on Wall Street. Mm-hmm. A lot of stupid money.
Now, before we wrap up here, I really want to get to the heart, because I know that you've cared about, as you put it to me earlier, fixing or killing, or however you want to put it, the fiat system.
Okay.
And Bitcoin was that you discovered that you thought, oh, this could be it. So you've clearly cared about this for a long time. What is something about the future world or the coming world that Bitcoin can help us get there? What's something you really care about seeing, perhaps in your lifetime or for your children, seeing manifest at this change?
Okay, so let's be careful. I don't want the fiat system to break down, particularly the US dollar. Fiats break all the time. I mean, you see it in Lebanon, Turkey, Argentina 4 times in my career, Venezuela. No disrespect to the citizens of all those nations. They don't matter. Like, we're talking, there's 3 currencies in the world that really matter, okay? You have USA, you have China, and you have the rest of the world, okay? And within the rest of the world group, you have a lot of things that, they fall off the map, but the world keeps on working because they didn't matter.
Economically speaking.
I'm not trying to be
GDP.
Correct. I'm not trying, for the citizens in those countries, my heart goes out to them. I don't want the US dollar to fail. It will fail, but I don't want it to happen quickly because we're not ready. And that the world would be a horrible place for a long time if the US dollar failed. So let's be careful. I don't want to kill fiat per se. Fiats die naturally. I don't want to kill the US dollar. What in fact I want to do is create a parallel system based on Bitcoin that will rescue the US dollar if it has to be rescued, or enhance the US dollar if in fact people get their act in gear and the US dollar can maintain its global reserve currency status. It's just that Bitcoin has become the reserve asset. Okay, so your question coming back is, what keeps me going, or what I can see? Equality for people in those less privileged countries whose fiats are going to fail no matter what. It's just math. They don't matter enough. They will eventually probably have to adopt a form or a peg to the US dollar for currency. My hope is those poorer nations, currently poorer, have adopted Bitcoin as their store of value before anyone else in the world, so that when this happens and Bitcoin is trading for millions of dollars of Bitcoin, those people who at the time were less privileged now become more privileged. And it's a great reversion to the mean amongst the populations of the world. Yeah. It's the reverse Cantillon effect, essentially.
And that's one of the things on a personal I really appreciate about you and Jeff Booth and Saylor and other folks too, because that's where my heart is, of seeing that global equality monetarily.
Yeah. But let's be careful. There is a desire for me to see the Western nations per se maintain their equality with, the ones that will leapfrog them. But it doesn't mean I say North America, has worked hard to establish where they are in the pecking order. It's not like, I mean, they have to go bankrupt. It means that people that own Bitcoin in the Western world will also benefit, as will those people in the less privileged countries. And that is the great leveling of opportunity. For the first time ever, people in Africa have the same chance to participate in a system and participate in an upside return as North Americans. It's very fair. Very good.
Yeah. Well, I appreciate your time. I thank you very much. And for the people listening that maybe are slightly curious or want to learn more, if you don't mind sharing, what is your personal Bitcoin allocation? And for someone just dipping their toes, are you saying they should go 100% all in Bitcoin? Or
No, and I will never say that. As a risk manager, I can't say that. But the great thing about Bitcoin is you don't have to be all in to participate in the asymmetry. I think Bitcoin, I told you, goes to $2 million or more, which is a price appreciation from $20,000 per Bitcoin of over 100 times. Imagine if you own 5% of your portfolio in something that goes up 100 times. All of a sudden, that's 5 times larger than everything else in your portfolio. Now, you're allowed to take profits. You're allowed to manage your risk buckets. But my best advice, I'll go to my grave saying this. If you own 0% allocation in Bitcoin, you're a horrible risk manager. You're just not managing risk properly. Bitcoin is an IQ test in risk management, and many people will fail that IQ test. Get off 0. My personal allocation is somewhere, it fluctuates based on prices of gold, of real estate, of other hard assets, but anywhere between 25 and 45% is my allocation. There's other people that can be higher than that, and maybe because they're younger, they don't have 3 kids like I have, they can sleep at night. I'm not telling you don't go higher, but you don't need to be at 100%. And I'm trying to sell this risk management technique to really big money who will never, ever have more than X% allocation to an asset that's not big enough, because Bitcoin's only a $500 billion asset. It's too volatile. And by the way, if they wanted to get a 10% allocation into it overnight, they would single-handedly move the price of Bitcoin up orders of magnitude. So all I'll say is get more than 0. I started with a comfort level of somewhere around 10%, and that increased to 40% or 25 to 40% over time. Manage it as the information comes in. And if the information changes, change your allocation. But most importantly, I will stress, I got involved in Bitcoin in 2016 at a price of under $1,000 US. Bitcoin is a better risk-adjusted investment today at $20,000 because of all the information and things that have come true than it was when I got involved in it at under $1,000.
The price has gone up by a factor of 20, but the information has made it 50 times better.
The government response to COVID has made it certain that the debasement of fiat currencies will accelerate to the point where it is mathematically impossible to escape this debt spiral. It's only math. It's less risky. Higher price, yes. Better upside for less risk. I love those types of investments.
Do you think that continues in the future? When Bitcoin's 200,000, do you think it'll...
I think it probably will, but we'll have to examine the information at that point in time.
Well, I hope we can meet again and examine the information later. So appreciate your time.
All right, it was great to meet you. Yeah. Welcome to the Bitcoin community, my friend.
Thank you.
You're a big asset already. So. All right.
Thanks. Hope I can continue.
All right, buddy. Good work.
Thanks.